Welcome back. The markets are now nearly 30% above their March lows, but where do we go from here? Joining me now, Charles Nenner. He's the founder and president of Charles Nenner Research. Daniel Weiner is the CEO of Advisor Investments and the editor of the Independent Advisor for Vanguard Investors. Charles, let me start with you. Shorts are getting a little nervous here. Most of the street is still net bearish. Most still think that we're going to come back and test the lows, but we're certainly getting a firm floor under the market right now. What does your research tell you is going to happen in the next 3 months?
Well, I agree with the shorts. As you remember, I came on with Mark Haynes in February. It says we're going to have a big rally, and I then thought I would go to 1,000 on the S&P, make everybody very happy. I don't think we're going to make it. And I agree, normally speaking, if you compare this movement, this bubble, to other bubbles, we have to go down again, and I think we'll be lower even than the last low in a few months.
And what do you base that on? Now, I know you're a big cycles guy. Is that the basis for your thinking we're going to hit new lows?
Yes, but it has been done research. As you know, maybe you don't know, I've been doing the market timing for Goldman Sachs for 12 years. And I used to give a presentation and gave classes. And one of the things that everybody should read, and I told my pupils at Goldman Sachs to read it, is a report by the Federal Reserve Board of New York called the Credit Slowdown of 1992. It gives you 10 steps, and if you read that presentation of the Federal Reserve Bank, you know exactly where we are in this situation.
All right. Dan, let me ask you, I want to put up the chart that you provided to me, which is cash as a percentage of the market capitalization of the S&P 500, and I previewed this just a few minutes ago at the top, and it's rather startling because it's a very good contrarian indicator. I wonder if you could put up that chart. We're at 15% cash. Now, look, we're going back 20 years here. 15% cash on the as a percentage of the market capitalization of the S&P 500. This is a great contrarian indicator, but explain why. What does this chart mean?
You're talking about there's $7 trillion worth of what they call money at zero maturity, cash, sitting on the sidelines. It's like an enormous tsunami waiting out there to flood the markets. You go to 2002, the bottom of the market, October 2002, market had dropped, what, 48%?
Right. Cash on the sidelines went way up.
Cash on the sidelines, but it was still only about 7%. We're talking about 15% of the market cap of the S&P sitting there ready to come in.
Put that chart back up because I want to show you how good the correlation was here. At the end of 2000, when the markets were at the top, that's when cash was at the lowest levels. It was down around, what, the 2-3% level.
3-4%.
Then the market bottom was October 2002. You can't see it quite there, but cash on the sideline went up to about 8% and then came back down again.
Right.
And it's a great contrarian indicator. Now we're at 15%.
But it's way beyond the
way beyond
what you've seen on the scale before.
Where do we go from here? Are you getting more comfortable with advising people, as Ned Davis did, to start overweighting, for example, the cyclical areas, overweighting techs, overweighting industrials at this point?
Well, we don't necessarily overweight particular sectors, as you know, because we've talked a lot about this, except for healthcare, because we believe that healthcare is a long-term sector you want to be in, particularly since you and I are getting so much older. But
thank you for that. Appreciate that.
My pleasure. My pleasure.
All right, it's not that funny.
But what we are seeing is that there are people who have gone to the sidelines in cash who are saying, I can't take 0.5% sitting in money markets. What do we do about this? Even the bears are saying, look, bonds are only going to give you real returns of a few 10, 20, 30 basis points over the next 6-7 years. Stocks are the place to be. So I don't know if we hit go back to retest the lows or not. Of course, the hedge funds are shorting because and they're talking about it because they've got to talk their books.
Yeah. Charles Nenner, gold topped 1,000 in February. I still get emails from the gold bugs who are insisting that the inflation cycle is coming back. Gold is going to go back to 1,000. Keep the faith, baby. These gold bugs, they never die. What's going to happen with gold?
No, keep the faith. It's going to take longer than you think. And just one thing about inflation is if you look at the economy of the last 200 years, you see that deflation is much more the rule than inflation. And if you look at the last 3-4 bull markets of the last 150 years, you see that bigger bull markets were made in deflationary periods and inflation periods. So we might as well have a deflation period with a very high gold price. My cycles bottom somewhere in the 2nd, 3rd week of May, and we're also holding there, and I'm convinced that we make a new high in a year in the gold price.
Okay, we got to go, but Dan, 5 seconds. Higher or lower on the S&P by the end of the year?
Higher.
All right,
Absolutely.
Thanks very much. Dan Weiner, thanks very much. Charles Nenner as well. Maria?